Have you ever wondered if there are, hidden pathways to keep more of your hard-earned money? Not for Uncle Sam, but really for you and your future. Today, we're pulling back the curtain on exactly that, uncovering the smart strategies that can dramatically reduce your tax burden and, frankly, supercharge your wealth.
Yeah, we're embarking on a deep dive into the strategic world of personal finance. Our mission today is pretty clear: to extract those vital nuggets of knowledge from, well, various financial instruments and planning techniques. The goal is really to show you how to truly minimize what you owe in taxes and maximize your financial well-being.
Absolutely. And whether you're just dipping your toes into financial planning or maybe you're a seasoned investor looking to sharpen your edge, this deep dive is, I think, custom tailored to give you the clarity and maybe those aha moments you need. We'll try to cut through the jargon, get straight to what matters most for your wallet, giving you actionable insights you can, apply right away. Okay, let's unpack this then. When we talk about qualified retirement plans, I think a lot of people just hear a savings account. Simple as that.
Yeah.
You're saying they're much more, right, with some pretty powerful built-in tax advantages. Can you maybe break down what makes them so unique? What's the most overlooked advantage, maybe?
That's a perfect starting point, actually, because you're right. They are far more than just a place to put your money. Think of these retirement plans less like savings accounts and more like financial fortresses. They're designed to keep your money growing, sure, but critically, they also offer a powerful shield against creditors. And they can even streamline the inheritance process for your loved ones, cutting through red tape and keeping more money in their pockets. Let's start with the immediate benefit: pre-tax or tax-deductible contributions. Imagine telling Uncle Sam, hey, I'm putting this money away for my future, so don't tax me on it now. That's essentially what happens. When you contribute to these accounts, that money is typically subtracted from your current taxable income, right off the top. It immediately lowers the amount of income the government sees for tax purposes this year. So it's basically an upfront tax break. It's like buying money at a discount, you could say. It dramatically boosts your effective return from day one. This is a really powerful incentive to contribute more, allowing you to essentially get an instant discount on your savings.
Okay, so an immediate tax cut right there. But does the money just sit there? Or does the magic really start once it's in the account?
Oh, the magic absolutely continues. That's the power of tax-deferred accumulation of earnings. What this means is your investments inside the retirement plan grow year after year without being subjected to annual taxation. Think about it. Outside these plans, if your investments generate interest or dividends or capital gains, you'd owe taxes on those earnings each year, a little bit chipped away constantly. But within these qualified plans, that money just compounds on itself, untaxed, until you withdraw way down the line in retirement. This allows for significantly greater growth over decades, as your money is literally making money on money, and the tax man isn't tapping into it until much, much later. That compounding effect is just massive over a lifetime. It truly amplifies your savings in a way that, frankly, taxable accounts simply can't match.
Wow, yeah, that untaxed compounding is huge.
And it gets even better. Beyond just growing your money efficiently, these plans also act as a kind of shield for your assets. Another crucial advantage is their asset protection from creditors. So in the unfortunate event of, say, lawsuits or bankruptcy or other financial claims against you, the assets held within these qualified retirement plans are often safeguarded from those claims. They create a sort of secure zone for your retirement nest egg, ensuring it remains intact even if you face unexpected financial troubles down the road.
That's reassuring. Peace of mind.
Exactly. And speaking of protecting your future and your legacy, here's another surprising layer of defense: probate avoidance. Now, probate is that formal, often lengthy, and frankly costly legal process where a court validates a will and oversees the distribution of assets after someone passes away. When retirement plans are set up correctly, maybe as part of a trust arrangement or an insurance contract with beneficiaries clearly named, they can bypass this entire process. This means your beneficiaries can receive the funds directly and much more quickly, avoiding potentially substantial court fees, attorney fees, accountant fees, all those costs that can otherwise chip away at the amount distributed to your loved ones. It's really a remarkable feature, offering robust protection not just from taxes, but also from unexpected financial claims and those lengthy, frustrating legal processes.
That's a vital distinction, yeah. Saving both time and money for your heirs seems critical. But, okay, with all these superpowers, there's always a kryptonite, right? What's the catch? What are the inherent trade-offs for these, incredible advantages?
You're spot on. There are always trade-offs. It's never all upside. While the tax benefits are substantial, you do accept certain limitations. For instance, When you eventually take income from these distributions, it's typically taxed as ordinary income. It's not taxed at the potentially lower rates of long-term capital gains. That's a key point. So even if your investments inside the plan grew from stock appreciation, the withdrawal itself is treated just like regular income for tax purposes when you take it out.
Okay, so ordinary income tax rates apply later. What else?
Additionally, assets within these plans are generally not liquid. This means they're really intended for long-term retirement savings. Accessing them prematurely can be difficult and costly. Most distributions taken before a specified age, typically that's age 59 and a half, are subject to a 10% penalty for premature distributions. Now, there are important exceptions, which we'll definitely discuss, but the core idea is that these funds are designed to be locked away for your future, not really readily available for immediate needs or, impulse spending.
Got it. Long-term focus.
Precisely. And just to give you a lay of the land, there are many types of qualified retirement plans, but 4 of the most commonly known ones that we'll focus on today include employer-sponsored 401ks, traditional IRAs, Roth IRAs, and annuity contracts. These are really the workhorses of tax-advantaged retirement saving for most people.
Okay, makes sense. And many of us, myself included, probably got started with retirement saving through our jobs. So let's dive into those employer-sponsored plans. You often hear terms like defined benefit and defined contribution. They sound kind of similar, but they're fundamentally different in how the risk is managed and maybe who truly owns that retirement security right.
You've hit on a key point there. The distinction is critical, especially concerning who bears the investment risk. It's fundamentally different. Let's start with defined benefit plans, often just called pension plans. These are the more traditional model. With these, the employer promises employees a specified monthly benefit at retirement, a defined outcome. This benefit might be a fixed dollar amount, or it could be calculated based on a formula, usually including factors like your age, your salary history, and years of service with the company. The crucial element here is the promise of a specific, predictable income stream in retirement.
Okay, so the employer guarantees a certain amount.
Exactly. And because the employer is making this promise, the employer bears the investment risk. They are responsible for ensuring there are sufficient funds to meet those promised benefits down the road. If the investments managed by the employer's appointed managers don't perform as expected, or if there's a shortfall, the employer has to use their own company earnings to make up the difference and fulfill their contractual obligation to the employees. This is where the employer really carries the heavy lifting of investment management and risk, having to utilize company earnings if funds fall short. It offers a very predictable income stream for the employee, which, sounds great, but fewer and fewer companies offer them today precisely because of that employer risk.
Right, they've become much rarer, so what's the alternative?
The alternative, and much more common today, is the defined contribution plan. These plans do not promise a specific benefit payment to you upon retirement. There's no guarantee of a certain income level. Instead, they operate more like individual savings accounts. Both you, the employee, and sometimes your employer, contribute a defined amount or percentage to this account. The emphasis shifts from the benefit to the contribution.
And the risk shifts too, right?
Exactly. In a defined contribution plan, the employee bears the investment risk. The value of your account fluctuates directly with the performance of the investments you choose within that plan, whether that's stocks, bonds, mutual funds, target date funds, or other options offered by the plan. Your retirement benefit is simply the balance in your individual account when you retire. That's the sum of all contributions, plus any investment gains or minus any losses. The most common type of employer-sponsored defined contribution plan, and one many listeners are probably very familiar with, is the Section 401k plan. It gives you more control, definitely, but also more responsibility for the outcome.
The 401k is indeed a cornerstone for so many retirement plans.
Absolutely. And specifically, that choice between a traditional and a Roth 401k represents a fundamental tax crossroads. It really forces you to ask, when do I want to pay my taxes? Now or later? So what does this all mean for our tax bill, both when we contribute and, crucially, when we eventually take money out?
The 401k is a cornerstone for a reason. It allows for substantial savings potential. Let's look at the numbers, using 2023 as our example year. The maximum amount an employee could contribute to a 401k was $22,500. And if you're age 50 or older, you get to contribute an additional catch-up amount, bringing your personal maximum up to $30,000. These are significant figures for building tax-advantaged wealth, allowing you to really build a sizable nest egg over your career.
And that's just the employee part, right?
Right.
What about the employer?
Right. When you factor in employer contributions like a match or profit sharing, the combined maximum that an employee and employer could contribute to an employee's 401k account for 2023 was a whopping $66,000, or even $73,500 if you're age 50 or older and taking advantage of that catch-up. These large limits truly highlight the potential for substantial tax advantage saving within these plans over a career. It's a powerful tool. Now, let's get to the critical distinction, traditional versus Roth within that 401k. With a traditional 401k, when you elect to contribute a portion of your wages, you do not pay current income tax on those contributed wages. This immediately reduces your taxable income for the year, giving you that upfront tax deduction. Tax savings now. It's important to note, however, that these wages are still subject to FICA and HUDA taxes. Those are for Social Security and Medicare. That doesn't go away. And if your employer also contributes to your traditional 401k, say through a match, those employer contributions are not taxable income to you at the time they are made. So this means both your contributions and your employer's contributions grow completely tax deferred.
Okay, so traditional means tax break now, pay taxes later. What about the Roth 401k?
In contrast with a Roth 401k, the wages you elect to contribute are fully taxable initially. This means you pay income tax on that money before it goes into your Roth 401k. You're using after-tax dollars. And if your employer allows for it and makes contributions designated as Roth, which is becoming more common but not universal, those employer Roth contributions are also taxable income to you at the time of contribution. This is a critical distinction for upfront tax planning. You're essentially choosing to pay the tax now rather than later in retirement. It's a calculated bet, really, on whether your tax rate will be higher now or in the future.
Okay, so the tax benefits definitely happen at different times. One gives you a tax break now, the other pays the tax up front. How does that play out when you actually start taking money out in retirement? That's when the real difference, and maybe the real value of that upfront decision, becomes crystal clear, right?
Precisely. The distribution phase is where your upfront tax decision truly shows its worth or its cost. For traditional 401k distributions, when you withdraw money from the plan in retirement, those distributions are fully taxable as ordinary income. This includes both your contributions, which you got a deduction for, and all the accumulated earnings over the years. You deferred the tax up front, so you pay it all on the back end at whatever your tax rate happens to be in retirement.
Okay, so traditional withdrawals, expense, fully taxable. How does Roth compare?
With Roth 401k plans, the situation is potentially much more favorable, assuming you meet certain conditions. Distributions of your principal, which are your contributions, are never taxable. Remember, you already paid tax on that money when you contributed it. That's the deal. The real power comes with the distributions of your earnings. These are only taxable if it's a non-qualified Roth distribution. This means if you don't meet the specific requirements for a qualified distribution, then a portion of the earnings will be taxed.
Okay, so what makes a Roth distribution qualified and therefore tax-free?
Good question. To clarify what qualifies as a qualified Roth distribution, you need to meet two main requirements. First, you, the taxpayer, must be age 59 and a half or older when you take the distribution. And second, your Roth 401k account must have been open for at least 5 years. This 5-year clock starts ticking from the first day of the calendar year in which you made your initial contribution to any Roth 401k plan sponsored by that employer. It's crucial to meet both these conditions, the age and the 5-year rule, for your earnings to be completely tax-free. If you take a non-qualified Roth 401k distribution, say you're over 59 and a half, but haven't met the 5-year rule yet, the amount is allocated pro rata between your principal, non-taxable, and your earnings taxable, based on their relative amounts in the account at the time of distribution.
Okay, that 5-year rule is key. Now, life happens, right? And sometimes you might need access to your money before retirement. What if you need to tap into this 401k money before age 59 and a half? Are there hefty penalties? And maybe more importantly, are there any strategic ways to avoid them and still keep your financial plan on track?
Unfortunately, yes, there is generally a 10% additional penalty tax on taxable distributions you receive from a 401k before reaching age 59 and a half. This penalty is on top of the regular income tax you'd owe on that distribution. It's a double hit. There is a slight variation for employer-sponsored plans. If you terminate employment with that specific 401k plan sponsor, you can avoid this penalty if you take distributions at age 55 or older, but still before 59 and a half. This is often referred to as the Rule of 55.
The Rule of 55. Okay, but what if you're younger than 55 or still employed? Are there other ways out of that penalty?
Yes. Thankfully, there are some key exceptions to this 10% penalty that are crucial to know about. For instance, if the distribution is used for unreimbursed medical expenses that exceed a certain percentage of your adjusted gross income, that's the AGI floor, the penalty can be waived. The same applies for distributions up to $5,000 made within the first year after the adoption or birth of a child. Or if you become totally and permanently disabled. Distributions made under a Qualified Domestic Relations Order, or QDRO, which often happens in a divorce settlement, are also exempt from the penalty. And distributions made after your death to a beneficiary, or if you are certified as terminally ill, avoid the penalty. Also, in cases of a federally declared natural disaster, you might be able to withdraw up to $22,000 without penalty. It's important to remember, though, that these penalty exceptions for 401ks differ somewhat from those available for IRAs. The specific rules matter depending on the account type.
Good to know there are exceptions. Now, what about when you leave a job? That seems like a common time people access 401k money.
Right. And a critical tax saving strategy, especially when you leave an employer, is the rollover of lump sum distributions. If you receive a lump sum distribution from your 401k after terminating employment, you generally have 60 days to roll that distribution over into another qualified retirement plan. That could be another 401k with a new employer, or more commonly an IRA. Doing so allows you to completely avoid paying income tax on the distribution in the current year, and it also bypasses that 10% penalty tax if you're under age 55. It's a crucial step to preserve your tax-advantaged savings and avoid a significant unnecessary tax hit. Essentially, it keeps your retirement money working for you within the tax-advantaged system. Makes sense. Keep it in the system. Now, what about the other end? When you have to take money out. Tell us about RMDs.
Right? Required minimum distributions, or RMDs. The IRS doesn't let you keep money in tax-deferred accounts forever. For traditional 401ks, the rule is you generally have to start taking distributions from your account by April 1st of the year after the later of two events. Either the year you reach age 73 or the year you actually terminate employment with the sponsor of that particular 401k plan. This means if you continue working past age 73 and are still contributing to that employer's 401k, you may be able to delay taking R&Ds from that specific plan until you actually stop working there, which is a nice benefit for older workers. But failure to take these R&Ds on time results in a stiff penalty, currently 25% of the amount you should have withdrawn. Though that penalty can be reduced to 10% if you correct the failure in a timely manner. Still, you want to avoid it. This really raises an important question for planning. Are you planning to work past 73? And how might that impact your RMD strategy and your overall retirement income plan?
Good point. Okay, so beyond employer plans, let's talk about individual retirement accounts, or IRAs. These offer incredible personal control over your retirement savings, right? And some very specific tax benefits. This seems like a powerful tool for almost anyone, giving you more direct say in your financial future and a way to save independently of your job.
That's absolutely right. An IRA is essentially a long-term, tax-advantaged savings account that individual taxpayers, not businesses, can fund with their earned income. A key feature is that the money you put in and the earnings it generates typically grow on a tax-deferred basis. And in many cases, particularly with traditional IRAs, your contributions may even be tax-deductible. It's truly your personal retirement powerhouse, offering flexibility and control.
Okay, so what are the limits? How much can you actually put into an IRA?
For 2023, the IRA contribution limits were specific. If you were under age 50, you could contribute up to $6,500, or your total earned income for the year, whichever amount was less. If you were age 50 or older, you got that catch-up contribution allowance, increasing your limit to $7,500, or your earned income. For married couples, the combined limit was $13,000, $6,500 each, or the couple's total earned income, if less. And if both spouses were 50 or older, that combined limit jumped to $15,000. $7,500 each, or their earned income. Now, crucially, these limits apply to the sum of your contributions across both traditional and Roth IRAs. You can't put the max in each. It's a combined total limit for the year.
Got it. Combined limit. And you mentioned earned income. What exactly counts for IRA purposes?
Defining earned income is vital for IRA eligibility, as you absolutely must have earned income to contribute. It's not for investment income. Earned income includes things like salary, wages, commissions, bonuses, and net earnings from self-employment. Also, alimony counts if the divorce or separation agreement was executed before December 31st, 2018. And certain non-tuition fellowship or stipend payments that are treated as taxable compensation can also count. However, earned income does not include passive income, like interest and dividends, annuity income, pensions, or alimony received under divorce agreements executed after 2018. Understanding this distinction is fundamental to knowing if you're even eligible to contribute to an IRA in the first place.
Okay, that's clear. Now let's talk about traditional IRA contributions. You mentioned they might be deductible. That sounds like navigating a bit of a maze. How does that deduction work?
It can feel like a maze sometimes, yes. The deductibility of contributions to traditional IRAs can vary. If they are deductible, These contributions are what we call above-the-line deductions. This means they reduce your adjusted gross income, or AGI, which is great because it can potentially lower your tax bill and maybe even help you qualify for other tax breaks. The contribution itself must be made by the tax filing deadline, which is typically April 15th, to count for the prior tax year. Importantly, getting an extension to file your tax return does not extend this contribution deadline. You still have to get the money in by April 15th.
So when isn't it deductible? What are the limitations?
The main complexity for traditional IRA deductibility arises if you, or your spouse if you're married, actively participate in an employer-sponsored retirement plan, like a 401k. If you are an active participant, your allowed deductible contribution starts to phase out proportionally once your AGI hits certain levels. For unmarried individuals in 2023, this phase-out range was between $73,000 and $83,000 AGI. For those married filing jointly, it was higher, between $116,000 and $136,000 AGI. This means if your income falls within or above these ranges, your deduction gets reduced or possibly eliminated entirely.
What if only one spouse is covered by a plan at work?
Good question. There's a special rule for married taxpayers, where only one spouse is an active participant in an employer's retirement plan. In this scenario, the deduction for the non-active spouse, the one without the workplace plan, is phased out based on the couple's combined AGI, but at a much higher range, between $218,000 and $228,000 for 2023. So the non-covered spouse has more room to deduct. However, if you're married filing separately, the AGI phase-out range is much, much narrower, basically $0 to $10,000 AGI for each spouse. This makes getting a deduction very unlikely if you file separately and participate in a plan. So while the deduction is powerful, it's definitely not automatic for everyone, especially higher earners with work-based plans.
Okay, let's make that concrete. Can you walk us through an example, maybe with Christy?
Sure, let's use Christy. She's a 40-year-old single taxpayer, and she's an active participant in her employer's retirement plan. Her 2023 AGI is $75,000. We need to figure out her maximum deductible IRA contribution. First, we see her $75,000 AGI falls within that phase-out range for single active participants, which was $73,000 to $83,000. Her income is $2,000 above the starting threshold, $75,000, $73,000. The total width of the phase-out range is $10,000, $83,000, $73,000. This means she's $2,000. $10,000 is 20% of the way through the phase-out range. So 20% of her potential deduction will be phased out, disallowed. Her maximum potential contribution for her age is $6,500. So we calculate 20% of $6,500, which is $1,300. This is the amount of her deduction that gets phased out. Finally, we subtract this phase-out amount from the maximum potential deduction. $6,500 minus $1,300 equals a maximum allowable IRA deduction of $5,200 for Christy. She can still contribute the full $6,500, but only $5,200 is deductible.
Okay, $5,200 deduction. Now, what if she wasn't covered by a plan at work? How would that change things?
That's the crucial contrast. If Christy wasn't an active participant in an employer-sponsored retirement plan, her maximum IRA deduction would be the full $6,500.
Why?
Why? Because those AGI limitations on deductibility generally don't apply if you don't have a retirement plan at work. This really highlights just how much participating in an employer-sponsored plan can impact your traditional IRA deduction eligibility, and why it's so important to understand these specific rules based on your situation.
Makes sense. Okay, let's switch gears to Roth IRA contributions. You mentioned the big draw here is tax-free growth and withdrawals later. What are the rules for getting money in?
Right, moving on to Roth IRAs. The core principle here, as you said, is different. Contributions are not deductible when made. You fund them with after-tax money, period. This is the complete opposite of the traditional IRA's potential upfront deduction. The significant tax benefit with a Roth IRA is realized much later, down the road, at the time of distribution, when qualified withdrawals are completely 100% tax-free, both contributions and earnings.
But can everyone contribute to a Roth IRA? Are there income limits here too? Yes, there are. While the deduction isn't the issue, the ability to contribute directly to a Roth IRA is limited by your income, specifically your modified adjusted gross income, or MGI. For unmarried individuals in 2023, the MGI phase-out range for contributions was between $138,000 and $153,000. For those married filing jointly, it was higher, between $218,000 and $228,000 MGI. And again, for married individuals filing separately, the phase-out is very narrow and punitive, really, $0 to $10,000 MGI. If your income is above the upper end of these ranges, you simply cannot contribute directly to a Roth IRA for that year. This is an important consideration for higher earners. But as we hinted earlier, there is a workaround involving conversions, which we'll get to.
Okay, so understanding those contribution rules and income limits is key for both traditional and Roth. But the real payoff or penalty comes at distribution time. Tell us, how do the tax rules for taking money out of traditional versus Roth IRAs differ? This is where that upfront planning, that decision to pay taxes now or later, truly shows its value, isn't it?
This is indeed where the rubber meets the road, tax-wise. As a general rule, just to reiterate, any taxable distributions from IRAs, traditional or Roth non-qualified earnings are taxed as ordinary income, regardless of how the money grew inside the account. No capital gains treatment on withdrawal. Let's break down traditional IRA distributions first. If you took a tax deduction for your contributions when you made them, then the distributions of that principal, the money you originally put in, are fully taxable when withdrawn. Furthermore, distributions of the earnings on that money are always taxable, whether or not you deducted the original contribution. Earnings are always taxable from a traditional IRA. Now, if you made contributions to a traditional IRA but did not deduct them, maybe your income was too high. These are called non-deductible contributions. When you take a distribution from an account containing non-deductible contributions, it's allocated pro rata. Part of it is considered a return of your non-taxable principal, the non-deductible contributions, and part is considered taxable earnings based on their relative amounts in the account. It requires some record keeping. And like traditional 401k, you're generally required to start taking required minimum distributions, or RMDs, from traditional IRAs by April 1st of the year following the year you reach age 73.
Okay, so traditional distributions are mostly or entirely taxable. What about the Roth IRA distributions? That's where the big tax-free promise comes in, right?
Exactly. The rules for Roth IRA distributions are designed specifically to give you tax-free income in retirement, provided you follow them. Distributions of your principal, meaning your contributions, are never taxable, full stop. This is because you already paid tax on that money way back when you contributed it, so you get your own money back tax-free anytime. Distributions of the earnings from your Roth IRA are only taxable if the distribution is a non-qualified Roth distribution.
Okay, same question as with the 401k then. What makes a Roth IRA distribution qualified so their earnings are tax-free too?
It's very similar to the Roth 401k rules, but applied to your Roth IRAs. A qualified Roth IRA distribution must meet two conditions. First, it must be made at least 5 years after the first day of the calendar year in which you made your very first contribution to any Roth IRA you own. This is that same 5-year rule. It applies across all your Roth IRAs collectively. Second, the distribution must meet one of the following additional requirements. You are age 59 and a half or older, or you are disabled, or you are using it as a first-time homebuyer, up to a lifetime maximum of $10,000 for this purpose, or the distribution is made to a beneficiary after your death. If you meet both the 5-year rule and one of these additional conditions, then the entire distribution, both your contributions and all your earnings, is completely tax-free. That's the Holy Grail. One other nice feature, when you take distributions from a Roth IRA, they're always considered to come first from your contributions, principal, then from your earnings. This is a very favorable ordering rule for taxpayers because it means you can often pull out your original contributions tax-free and penalty-free at any time, even before age 59 and a half, without touching the taxable earnings until later.
That ordering rule seems really helpful. Can we run through that Sally example again? It really helped clarify the 401k differences. How would it look for IRAs?
Absolutely. Let's revisit Sally. Remember, she opened an IRA when she was 55 years old and contributed $5,000. Several years later, the account had grown to $8,000. She then withdrew $6,000 for a vacation. Let's look at the 4 IRA scenarios. Scenario 1, traditional IRA, where Sally took a tax deduction for the contribution. In this case, the entire $6,000 distribution is taxable as ordinary income. Since she received that upfront tax break via the deduction, the entire withdrawal is taxed on the back end, simple but fully taxable. Scenario 2, traditional IRA where a deduction was not taken for the contribution. Maybe her income was too high. Here, the distribution of principal, her non-deductible $5,000 contribution, is not taxable, but the earnings are. Her $8,000 account balance consists of $5,000 principal and $3,000 earnings. That means 62.5% is principal, $5,000, $8,000, and 37.5% is earnings, $3,000, $8,000. So we apply that earnings ratio to her $6,000 distribution. $6,000 multiplied by 37.5% equals $2,250 in taxable ordinary income. The rest, $3,750, is a tax-free return of her non-deductible contribution. This shows the pro rata rule in action.
Scenario 3, Roth IRA, where the amount was withdrawn just 4 years after the contribution. This is a non-qualified distribution because the account hasn't been open for the required 5 years yet. But remember the ordering rule. Distributions come first from principal. Her $6,000 distribution consists of her entire $5,000 non-taxable principal contribution coming out first. The remaining $1,000 must come from earnings. Since it's non-qualified due to the 5-year rule, this $1,000 of earnings is taxable as ordinary income. So only $1,000 is taxed here. Scenario 4, Roth IRA, where the amount was withdrawn 6 years after the contribution. In this scenario, the Roth IRA has been open for at least 5 years, 6 in fact, and Sally is now 61 years old, 55 at contribution plus 6 years later, which is over the age 59.5 requirement. This makes it a fully qualified Roth distribution. Therefore, neither the principal nor the earnings are taxed. The entire $6,000 withdrawal is completely tax-free. So $0 is taxable ordinary income. This example, I think, powerfully illustrates the vast tax differences and really hammers home the importance of meeting those Roth qualified distribution requirements, especially the 5-year rule and age 59.5, to get that truly tax-free growth in income.
Wow. Yeah, that Sally example really drives home how crucial the type of IRA you choose, and maybe more importantly, when you take the money out, can be for your final tax bill. Huge difference between $6,000 taxed and $0 taxed. But again, what if you still need to access IRA funds early, before 59.5? And what are the final rules around required distributions when you get older, especially for those Roth IRAs? You mentioned a key difference there.
The rules for early withdrawals in RMDs are quite similar to 401ks, but yes, with some notable distinctions, particularly for Roth IRAs and exceptions. Generally, just like a 401k, a premature distribution from an IRA before age 59.5 is subject to that 10% penalty tax in addition to any regular income tax owed. It's the IRS's way of reinforcing that this money is meant for retirement.
But there are exceptions for IRAs too. Are they the same as the 401k ones?
Mostly similar, but with a few key differences in the exceptions for IRAs. One big one is using the distribution as a first-time homebuyer. You can withdraw up to $10,000 penalty-free, lifetime limit, if used within 120 days to buy, build, or rebuild a first home. This isn't available for most 401k. Another is if you're unemployed and have received 12 consecutive weeks of unemployment compensation, distributions used specifically for health insurance premiums are exempt from the penalty. Withdrawals for medical expenses exceeding that AGI floor or for permanent disability also avoid the penalty, similar to 401ks. Critically, for many families, distributions used for qualified higher education expenses, things like college tuition, books, fees for yourself, spouse, kids, or grandkids, are penalty-free from an IRA. This is another major exception, not usually available for 401k. And similar to 401ks, there are also exceptions for adoption or birth of a child, that $5,000 max within 1 year, death or terminal illness of the account owner, and those federally declared natural disasters, up to $22,000 max exclusion.
Okay, so IRAs offer a bit more flexibility with penalty exceptions for things like education and first homes. That's good to know. What about RMDs?
Regarding required minimum distributions, or RMDs, for traditional IRAs, the rule is essentially the same as for someone not still working past 73 with a 401k. You must start taking these distributions by April 1st of the year, following the year you reach age 73. For IRAs, there's generally no still employed exception allowing you to delay further. However, and this is a crucial and incredibly powerful advantage of Roth IRAs, the RMD requirements do not apply to Roth IRAs for the original owner. This means you can leave the funds in your Roth IRA for as long as you wish during your lifetime, allowing for continued tax-free growth potentially for many more years. You are never forced to take money out. This provides immense flexibility for your own retirement planning and, significantly, for estate planning for your heirs, as the account can continue growing tax-free even after you might otherwise need the income. The penalty for failing to take a traditional IRA RMD is also that steep 25% of the amount you should have withdrawn, which can be reduced to 10% if corrected in a timely manner. But avoiding RMDs altogether is a huge plus for Roths.
That Roth IRA RMD exception really does sound like a game changer, especially for legacy planning, allowing that money to just keep growing tax-free, potentially for generations. Wow. Okay, shifting focus slightly. What about those of us charting our own course? The self-employed, the freelancers, the small business owners. Are there specific tax-saving retirement options tailored just for them to build their nest egg while minimizing taxes?
Absolutely. The self-employed, whether you're a solo entrepreneur, a gig worker, or run a small business with maybe just a spouse as an employee, have some excellent retirement savings options that provide significant tax benefits, often even better than traditional employees get. Contributions made to these qualified self-employed retirement plans are typically deductible above the line, meaning they directly reduce your adjusted gross income, lowering your taxable income up front. And like other qualified plans, the earnings within these accounts grow tax-deferred until they're distributed. When you eventually take distributions, they're fully taxable as ordinary income and are subject to the same early withdrawal before 59.5 and late distribution RMD penalties we've discussed for other retirement plans. A relatively new development starting in 2023 is that these self-employed plans can now also be designated as Roth plans if the plan provider offers it. This means contributions would be made after tax, not deductible, but qualified distributions in retirement would be non-taxable. So that Roth option is expanding.
Okay, so what are the main types of plans for the self-employed and how much can they contribute?
The maximum amount you can contribute each year really depends on the type of plan you choose. The three most common types are, first, the SEP IRA, which stand for Simplified Employee Pension IRA. This is often the simplest to set up and administer, especially for solo operators. For 2023, the maximum contribution was the lesser of 20% of your net adjusted self-employment income, which is your net income after deducting 1/2 of your self-employment tax, or a dollar limit of $66,000. If you were age 50 or older, that dollar limit increased for catch-up contributions, potentially allowing even more, though the percentage limit still applies. It's a great option for high-income solo professionals due to that high dollar cap. Correction. The outline states $73,500 for 50 plus for SEP, but SEP IRAs technically don't have catch-up contributions like 401k simples. The limit is based on compensation, up to the overall 66K cap. I'll stick to the 66K cap mentioned in the outline for consistency, but acknowledge this nuance internally. Let's stick with the $66,000 limit for clarity, as per the outline.
Okay, SEP IRA, simple, high potential contribution. What else?
Second, the Simple IRA, which stands for Savings Incentive Match Plan for Employees. This is often used by smaller businesses that do have some employees, but it can also be used by the self-employed. For 2023, the maximum contribution was generally lower, the lesser of 100% of your net adjusted self-employment income, or a dollar limit of $15,500. If you were age 50 or older, you can make an additional catch-up contribution, bringing that limit up to $19,000. The contribution limits are lower than a SEP, but it's still a solid option.
Got it. SEP, simple. What's the third one?
And third, the Solo 401k, also known as an individual 401k. This plan is specifically designed for self-employed individuals with no employees other than potentially a spouse. For 2023, the maximum contribution rules are a bit more complex, but potentially very high. It's essentially the lesser of that same 20% of net adjusted self-employment income calculation or the overall dollar limit of $66,000. If you're age 50 or older, that overall limit increases to $73,500, thanks to the standard 401k catch-up rules. The Solo 401k often allows for both an employee contribution, up to the standard 401k individual limit, $22,500 or $30,000 at 50 plus in 2023, and an employer profit-sharing contribution, up to 25% of compensation, limited by the overall cap. This combination allows many self-employed individuals to contribute significantly more than they could with a SEP or Simple IRA, especially at lower income levels. These plans provide really robust options for entrepreneurs to save significantly on a tax-advantaged basis, often giving them more flexibility and higher contribution potential than a traditional employee might have.
That solo 401k sounds particularly powerful. Okay, now let's talk about a strategy that's gained a lot of buzz. Roth conversions. This seems like a really powerful way to supercharge your tax-free future, especially for higher earners who might be blocked from contributing directly to a Roth IRA. Tell us about Roth conversions. How do they work and what are the tax implications?
Roth conversions offer a unique and often very strategic opportunity to shift money from a traditional tax-deferred retirement account like a traditional IRA or a traditional 401k into a Roth account like a Roth IRA. The big appeal: you're essentially transforming future taxable income into future tax-free income. The process involves moving funds from the traditional account to the Roth account. This can be done either through a direct trustee-to-trustee transfer, where the money never touches your hands, or via a 60-day rollover, where you receive the distribution from the traditional account and then you must personally contribute it into a Roth account within 60 days. The direct transfer method is generally preferred as it avoids potential pitfalls, like missing that 60-day window, and avoids mandatory tax withholding.
Okay, so you move the money. What's the tax hit? Because there has to be one, right?
Yes, there is a significant tax implication. The total amount transferred or rolled over from the traditional account is generally taxed as ordinary income in the year of the conversion. This means you're essentially accelerating your tax payment. You're choosing to pay the tax on that money now at your current tax rate instead of deferring it until retirement. However, a direct transfer or a properly executed 60-day rollover is not subject to the 10% premature distribution penalty, even if you're under age 59.5 when you do the conversion. The IRS views it as a transfer, not an early withdrawal for spending. A 60-day rollover, though, could be subject to the penalty if, for some reason, you fail to get the full amount into the Roth account within that strict 60-day period. Another reason direct transfers are usually better.
Got it. Pay ordinary income tax now, no penalty. So what's the big advantage? Why pay tax now?
The key advantage, and what makes Roth conversions so powerful, particularly for higher earners, is that unlike direct contributions to a Roth IRA conversions are not subject to an annual contribution cap or those adjusted gross income restrictions. Remember how we said if your income is too high, you can't contribute directly to a Roth IRA? Well, there's no income limit on converting money from a traditional IRA to a Roth IRA. This creates what's commonly called the backdoor Roth IRA strategy. Even if your income is too high for direct Roth contributions, you can potentially make a non-deductible contribution to a traditional IRA and then promptly convert it to a Roth IRA. Since the initial contribution wasn't deductible, only the earnings, if any, generated before the conversion would be taxed. More broadly, it provides a pathway for anyone with traditional retirement funds to get that money into a Roth IRA and enjoy potentially decades of tax-free growth and tax-free qualified withdrawals later on.
The strategic decision boils down to whether it makes sense for you to pay the tax now at your current rate, based on your expectation of potentially higher tax rates for yourself or the country in the future when you would otherwise withdraw the money from the traditional account. It's like paying a potentially smaller toll now to drive on a completely tax-free highway for the rest of your financial journey.
That backdoor Roth is definitely something a lot of people ask about. Okay, let's touch briefly on another tool, annuities. How do these fit into a tax-advantaged financial plan, particularly with their own flavor of tax-deferred growth? They can seem a bit complex or intimidating for some, but they offer unique benefits, especially for folks seeking guaranteed income streams later in life.
Annuities are another category of long-term tax-advantaged accounts. In terms of taxes, they're very similar to traditional IRAs in that their earnings accumulate on a tax-deferred basis. The contract itself is between you, the taxpayer or annuitant, and an insurance company. Fundamentally, they're designed to provide a steady income stream, often specifically for retirement, which makes them very attractive to people looking for predictability and protection against outliving their savings.
Okay, tax-deferred growth like an IRA, are there different kinds?
Yes, there are two main types based on when payments begin: immediate annuities and deferred annuities. An immediate annuity is typically purchased with a single lump sum payment, and in exchange, you begin receiving income payments perhaps for a fixed period, or more commonly for a life relatively quickly, usually starting within 30 days to a year. They don't really have an accumulation phase. They're all about turning a lump sum into immediate regular income. Deferred annuities, on the other hand, are more common for long-term retirement planning. They have two distinct phases. First, there's an accumulation phase where you make payments, premiums, into the contract, either as a lump sum or over time. During this phase, these premiums have the potential to grow on that tax-deferred basis we mentioned. Then there's the payout phase, where you eventually begin receiving distributions, often years or decades down the line, based on the terms you selected.
And within deferred annuities, are there different ways they grow, different risk levels?
Yes, deferred annuities can come with different risk and return profiles. Fixed annuities offer guaranteed minimum returns set by the insurance company. They are not directly subject to market volatility, providing stability and predictability, much like a CD, but with tax deferral. Variable annuities fluctuate in value based on the performance of underlying investment options, often similar to mutual funds that you select. So they carry market risk but also offer potential for higher returns. Your account value goes up or down in the markets. Equity indexed annuities try to offer a middle ground. Their returns are linked to the performance of a market index like the S&P 500, but they often come with a guaranteed minimum return, or a floor, protecting against significant losses while also capping potential upside gains. They aim to combine some market participation with downside protection. It's important to note that fixed and equity indexed deferred annuity contracts are considered general account products of the insurance company.
This means the guarantees are backed by the claims-paying ability of the insurer, and your funds could be subject to the claims of the insurer's creditors if the company were to fail, unlike assets in separate accounts used for variable annuities.
Okay, different types, different risks. How are the payments taxed when you finally start receiving income from an annuity? Is it all taxable?
The tax treatment of annuity payments during the payout phase is unique. It's generally not all taxable at once. Each payment you receive typically consists of two parts: a non-taxable return of your original investment, your contributions or premiums paid, and taxable earnings. You get your own money back, tax-free, but pay tax on the growth. The calculation of how much of each payment is taxable versus non-taxable depends on whether it's a fixed period annuity or a life annuity.
How does that calculation work for a fixed period?
For a fixed period annuity, where you know the exact total number of payments you'll receive, for example, for 10 years, 20 years, use what's called the annuity exclusion ratio. This ratio is calculated as your original investment, total premiums paid, divided by the expected total value of the annuity, payment amount times the number of payments. This ratio represents the percentage of each payment that is considered a non-taxable return of your capital. The rest is taxable earnings. Let's use an example. Suppose Zoe purchased an annuity for $50,000. The contract guarantees to pay her $750 per month for exactly 120 months, 10 years. The expected total value she'll receive is $750 times 120 months, which sums up to $90,000. Her annuity exclusion ratio is her original investment, $60,000, divided by the expected value, $90,000, which equals 0.667 or 66.7%. This means 66.7% of each payment is a tax-free return of her capital. Therefore, the taxable portion of each annuity payment is 100% minus 66.7%, which is 33.3%. So 33.3% of her $750 monthly payment, or $249.75, is taxable ordinary income each month. The remaining $500.25 is her non-taxable return of capital.
Okay, that makes sense for a fixed term. What about a life annuity, where you don't know how long the payments will last?
Right, for a life annuity, where the payments are guaranteed for your lifetime and the total number of payments is therefore unknown up front, you can't use the same simple ratio. Instead, you use IRS life expectancy tables to determine the non-taxable portion of each payment. You divide your original investment by an appropriate factor found in the IRS tables, which represents your life expectancy in months at the time the annuity payments begin. The result is the amount of each monthly payment considered a non-taxable return of capital. For instance, let's say John purchased an immediate life annuity for $60,000. It pays him $600 per month for the rest of his life. John is 64 years old when the payments start. We look up the IRS life expectancy factor for someone age 64, and let's say it's 260 months. To find the non-taxable return of capital per month, we divide his $60,000 original investment by 260 months, which equals $230.77. The taxable portion of each $600 monthly payment is in the total payment minus the non-taxable portion. $630, 277 equals $369.23. So $369.23 is taxable ordinary income each month. Now, what happens if John lives longer than 260 months? Once he has received 260 payments, he is fully recovering his original $60,000 investment tax-free. Any subsequent $600 payments he receives after that point become fully taxable. Conversely, if John dies before receiving 260 payments, say after only 250 months, the remaining unrecovered investment, $230.77 times the remaining 10 months equals $2,307.70, can generally be deducted on his final income tax return as an itemized deduction. These examples show the unique tax implications of annuities based on their structure and why they can be a key part of creating predictable, tax-managed retirement income.
Okay, that's a lot to absorb. Annuities, IRAs, 401k, traditional Roth, contribution limits, deduction phase-outs, RMDs, it all sounds quite complex. How does someone actually choose the right path for themselves to maximize their tax savings? It feels like a really big decision with so many interacting pieces. Where do you even start?
You're absolutely right. It can definitely feel like a lot to navigate, especially with all the different rules and options. But after securing the full employer match, the next fundamental principle for tax optimization is that traditional versus Roth decision. And as we've discussed, this really hinges on comparing your current marginal tax rate versus your expected future marginal tax rate around the time you plan to take distributions. This is essentially a calculated bet on where tax rates, both yours personally and perhaps tax laws, generally will be in the future. Generally speaking, you'll likely be better off contributing to a traditional account, like a traditional 401k, or a deductible traditional IRA, when your current marginal tax rate is higher than your expected future marginal tax rate. Why? Because the tax savings you get up front through those pre-tax contributions are more valuable now when your rate is high. Conversely, you'll generally be better off contributing to a Roth account, like a Roth 401k or Roth IRA, when your current marginal tax rate is lower than your expected future marginal tax rate. In this case, the tax savings come at the end through those qualified Roth distributions that are completely tax-free. Paying the tax now at a lower rate is better than paying it later at a potentially higher rate.
This raises that really important personal question. Do you anticipate being in a higher tax bracket in retirement or when you plan to take distributions? Your honest answer to that heavily influences this choice. And it's not a set it and forget it decision. It's something to regularly revisit as your income and tax laws change.
So, match first, then traditional versus Roth based on current versus future tax rates. Is there anything else that might tip the scales, say, towards Roth?
Yes. One additional and very powerful advantage that a Roth IRA has over almost all other retirement accounts is that it's the only type that doesn't require required minimum distributions, RMDs, for the original owner. As we discussed, this means you can leave the funds in the Roth IRA account for continued tax-free growth indefinitely during your lifetime, even well past age 73. You are never forced to take money out if you don't need it. This provides immense flexibility not only for your own later years, but also makes Roth IRAs an exceptionally strong tool for estate planning, allowing you to potentially pass on a larger, completely tax-free legacy to your heirs. That lack of RMDs is a unique and compelling benefit.
That's a great summary. Can we tie all together with that Paul Smith example? Seeing it applied practically really helps solidify these concepts.
Absolutely. Let's walk through Paul Smith's situation again as it brings many of these principles together. Quick recap. Paul is 55, single, and wants to contribute $15,000 to his retirement accounts this year. He's eligible for both a Roth or a traditional 401k through his employer, and his employer offers a generous dollar-for-dollar match up to $10,000. Paul's current AGI is high enough that he cannot contribute directly to a Roth IRA, nor can he deduct any contributions made to a traditional IRA. So those options are off the table for direct contributions or deductions. He's currently in a 21% marginal federal tax bracket, which he considers relatively low. Crucially, he expects tax rates generally to increase in the future, and he anticipates being in a much higher tax bracket himself when he starts taking distributions in retirement. Okay, match available, high income blocking IRA options, low current tax rate, expects higher future rate. What should Paul do? Given Paul's specific situation and outlook, the optimal solution is clear. All $15,000 that he wants to save should be contributed to Paul's Roth 401k. All of it to the Roth 401k. Here's the step-by-step rationale. First, Paul absolutely needs to contribute at least $10,000 to his 401k, whether Roth or traditional, to capture that full $10,000 for dollar employer match. That's rule #1. It's free money, an immediate 100% return. He must do this. Second, since his high AGI prevents him from contributing directly to a Roth IRA or deducting a traditional IRA contribution, the 401k through his employer is his best, and really only, direct path for significant tax-advantaged savings beyond just getting the match. It's the vehicle available to him. Third, Paul is 55, so he's eligible for catch-up contributions. For 2023, the 401k contribution limit for those 50 and older was $30,000. His goal of contributing $15,000 is well within this limit.
Okay.
This means he has plenty of room to put his entire desired $15,000 into the 401k.
Okay, so you can put it all in the 401k, but why specifically the Roth 401k?
The rationale for choosing Roth here is critical and directly tied to his tax rate expectations. Paul is currently in a 21% tax bracket, which he believes is low compared to where he'll be in the future. By contributing to the Roth 401k now, he pays that 21% tax today on his contributions. When he starts taking distributions, let's say in 10 years when he's 65, he will have easily met both the age 59.5 requirement and the 5-year rule for his Roth 401k, assuming he started it timely. This means the entire distribution, both his $15,000 in contributions and all the accumulated investment earnings over those 10-plus years, will be completely tax-free, even if he's in, say, a 35% or higher tax bracket then. He locks in the lower rate now.
Okay, that makes sense. What would happen if he chose the traditional 401k instead?
Let's contrast that. If Paul instead contributed the $15,000 to a traditional 401k, he would get a current year tax reduction, yes, but only at his current 21% marginal tax rate. That saves him some tax today. However, when he takes distributions later in retirement, 100% of that money, his contributions, plus all the earnings, would be fully taxable at what he expects to be a much higher future marginal tax rate. That would likely result in paying significantly more tax overall compared to the Roth option. It would be a less efficient use of his tax savings opportunity, essentially locking in a higher tax bill later when his rate is expected to be higher. Similarly, while he could technically contribute to a traditional IRA, since there's no income limit on contributing, just on deducting, his AGI is too high for him to deduct the contribution. This would mean making non-deductible contributions no current tax benefit, and while his contributions would come out tax-free later, the future distributions of earnings would still be fully taxable at ordinary income rates. That's generally the worst of both worlds, making it much less appealing than the Roth 401k for his specific situation. This example truly encapsulates how making strategic choices about where and how to save, informed by your current and expected future tax outlook, can make a profound difference in your long-term financial well-being and how much wealth you actually get to keep.
Fantastic breakdown. Okay, let's shift gears slightly from retirement accounts. When we look at regular investments, outside of those tax shelters, it's not just about what your investment earns on paper, but what you actually keep after taxes bite into it. How do we figure that out? How do we make truly informed investment decisions considering the tax impact? Because a headline return figure can be really, really misleading sometimes.
That's an excellent and often overlooked point. Many people focus solely on the headline return, the gross return of an investment. But the true measure of profitability, the number that actually matters to your wealth, lies in what you take home after taxes. Let's start with the basic return on investment, or ROI. This is the simple ratio most people think of. Calculation. Take the investment sales price, subtract the cost of the investment, and then divide that profit by the original cost of the investment. For example, if you buy something for $100 and sell it later for $125, your profit is $25. Your ROI is $25 divided by $100, which equals 0.25 or 25%. Looks good on paper. However, this basic ROI ratio completely ignores two critical factors: the length of time you held the investment, which impacts annualized returns, and, crucially for this discussion, the taxes you'll eventually have to pay on that $25 gain.
Right. So how do we factor in those taxes to get a real picture?
This is where the after-tax rate of return, or ATRR, comes in. It is the much more accurate measure of an investor's true return because it explicitly accounts for the impact of income taxes. The formula for ATRR is pretty straightforward. You take your pre-tax return on investment, ROI, and multiply it by 1 minus your applicable marginal tax rate on that specific type of investment income. The real genius, or maybe just the necessity, here is how it reveals the true profitability, showing you what percentage you actually keep in your pocket. It's fascinating, as you said, how often people overlook this crucial step. They compare investments based on pre-tax returns, leading to potentially flawed decisions and a distorted view of how well their investments are truly performing for them after Uncle Sam takes his cut.
Okay, ATRR equals ROI, one tax rate. Can you see that in action? Maybe with that Alice and Robert Peters example? High income, high taxes seems like it would make a big difference for them.
Absolutely. Let's use Alice and Robert Peters to illustrate the profound impact taxes can have on investment returns. Quick reminder, they are a high-income couple, both professionals, with household income over $500,000. Their combined marginal federal income tax rate is 35%. Their state income tax rate is 6%. And because of their high income, they also pay the 3.8% net investment income tax in IIT on certain types of unearned income. So their total combined marginal tax rate on this particular investment income is 35% plus 6% plus 3.8% plus 44.8%. That's a hefty tax rate. Now they're considering an investment, contributing $100,000 to an LLC. The LLC anticipates purchasing some real estate with the hope of selling it fairly quickly for $125,000. So let's calculate their true after-tax return on this potential investment. Step 1. Calculate the return on investment, ROI, using our basic formula. $125,000 sales price, $100,000 cost. $100,000 cost $25,000, $100,000, 0.25 or 25%. So the gross return looks impressive, solid 25%.
It's been 25% ROI. That's great so far.
Step 2. Calculate their combined effective tax rate. As we determined, their combined federal, state, and NIIT rate applicable here is 44.8%, nearly half.
Okay, 44.8% tax rate. Now for the ATR.
Step 3. Calculate the after-tax rate of return, ATRR. Now we apply the APR formula. We take the ROI, 0.25, and multiply it by 1 minus their tax rate, 0.448. So ATR equals 0.25, 4.448%, 0.552, and that equals 0.138, or 13.8%.
Wow. So that 25% return gets slashed down to just 13.8% after taxes? That's a huge difference.
It's a massive difference. This example powerfully emphasizes just how significant the gap can be between a gross pre-tax return and the actual after-tax return you get to keep and spend or reinvest. Nearly half of their potential 25% gain vanishes due to taxes in their high bracket. Ignoring this crucial after-tax calculation would lead them to have a severely inflated and misleading perception of this investment's true profitability. The lesson is clear. Always consider the ATRR when evaluating and comparing investment opportunities, because what you keep is what truly matters for building wealth.
That's a critical takeaway. Always look at the after-tax return. Now, beyond retirement accounts and general investment principles, even specific types of investments like bonds have different tax treatments that can make a huge difference to your bottom line, right? It's not just about the interest rate they pay, but how that interest is taxed that can really impact your take-home income, especially for fixed income investors.
Absolutely. The tax implications of different investment types are a critical component of smart financial planning, and bonds are a perfect example of this. Let's look at a few common types. For corporate bonds, BARM issued by companies, the interest income you receive is typically subject to both federal income tax and state income tax, unless you live in a state with no income tax, of course. This also generally applies to U.S. government bonds like Treasury bonds or federal agency bonds. For tax purposes, their interest is usually taxed at the federal level, though often exempt from state and local taxes, but still federally taxable. So while these bonds can offer relatively stable income, you need to remember that that income will be reduced by taxes, sometimes significantly depending on your bracket.
Okay, so corporate and federal bond interest is generally taxable. What's the alternative for tax savings in the bond world?
The alternative, And where the significant tax advantage comes into play is with municipal bonds, often called munis. These are bonds issued by state and local governments or their agencies. The crucial tax advantage is that the interest income generated from municipal bonds is generally exempt from federal income tax. And in most cases, it's also exempt from state and local income taxes if you are a resident of the state or locality that issued the bond. This is the double tax exempt or triple tax exempt benefit you sometimes hear about. This unique tax exempt status makes municipal bonds highly attractive, especially to higher income taxpayers who are in higher federal and state tax brackets. They are looking for ways to generate income more efficiently and keep more of what they earn. For someone in a high tax bracket, the after-tax yield on a municipal bond can actually be significantly higher than the after-tax yield on a corporate or treasury bond that has a seemingly higher stated interest rate. Calculating that tax equivalent yield is key when comparing munis to taxable bonds. That tax equivalent yield calculation is important. Is there anything else tricky about taxes and bonds, maybe related to borrowing?
Yes, there's an important nuance related to deducting loan interest when bonds are involved. If a business, or an individual using margin perhaps, borrows money specifically to purchase taxable bonds like corporate or U.S. Treasury bonds, the interest expense incurred on that loan is generally deductible, subject to investment interest expense limitations. Why? Because the income generated from those bonds, the interest received is taxable. The expense helps generate taxable income. However, if you borrow money specifically to purchase tax-exempt municipal or state bonds, the interest expense you pay on that loan is not deductible. The IRS doesn't allow you to deduct expenses associated with generating tax-exempt income. You can't get a deduction for borrowing money to earn income that isn't taxed in the first place. It's called the tax arbitrage rule. This raises an important planning question. Are you factoring in not only the tax-exempt nature of some bond income, but also the corresponding lack of interest deductibility if leverage is used when comparing investment opportunities? Understanding this distinction is vital for accurate after-tax calculations and avoiding disallowed deductions.
Good point. The non-deductibility of interest expense for munis is key if leverage is involved. Okay, let's pivot to another major financial goal, education. Education costs are just soaring. We all know that. And for so many families, figuring out how to fund college or other post-secondary education without completely breaking the bank is a huge challenge, a major source of stress. Thankfully, the tax code does offer several ways to make it less burdensome. How can we use these tax-efficient vehicles strategically to help fund those future minds and alleviate some of that financial pressure?
You're absolutely right. Education is a significant investment, and the costs can be daunting. But the tax law does provide several powerful tools designed specifically to help families save and pay for education more efficiently. We have a whole suite of tax-efficient education savings vehicles available. The main ones include Section 529 Qualified Tuition Programs, QTPs, Coverdell Education Savings Accounts, ESAs, and even U.S. Series E-Savings bonds used for education. We could also mention Uniform Gift to Minors Act, UGMA, or Uniform Transfer to Minors Act, UTMA custodial accounts, although their tax treatment is a bit different. And of course, beyond these savings vehicles, families should always explore other funding avenues like traditional financial aid, FSEA, Pell Grants, other federal or state grants, scholarships, and if necessary, various types of student loans to bridge any remaining funding gaps. But focusing on the tax advantage options first is usually wise.
Okay, let's start with the big player, the one most people probably hear about. Section 529 plans. What are they, and what makes them so popular for education savings?
Right. Section 529 Qualified Tuition Programs, or QTPs, are definitely the heavy hitters in the education savings world. These are programs established either by a state government or, less commonly, by an eligible educational institution itself. They essentially allow taxpayers to either prepay qualified educational expenses through a prepaid tuition plan or contribute to an educational savings plan to save for those future costs. The key tax advantages are really significant. First, the earnings on the investments within the 529 plan grow tax-deferred over the years. No annual taxes on the growth. And second, if the money is eventually withdrawn and used for qualified education expenses, those distributions, including all the accumulated earnings, are completely income tax-free at the federal level. Additionally, many states offer their own state income tax deduction or credit for contributions made to their specific state's 529 plan, providing an extra upfront incentive for residents of those states. That combination of tax-deferred growth, tax-free withdrawals, and potential state tax breaks makes them very powerful.
You mentioned two types, prepaid tuition and savings plans. What's the difference there?
Good distinction. The prepaid tuition plan is designed to let you lock in future tuition costs at today's prices, or something close to it. You're essentially buying units or credits of future tuition at participating colleges, usually in-state public institutions. The plan guarantees that the value of your contributions will increase at the same rate as college tuition within that system. This makes it a very low-risk, tax-advantaged vehicle. It's generally exempt from federal income tax and potentially state-local taxes, too. Often, it's even guaranteed by the full faith and credit of the state, offering a strong sense of security about covering tuition. The main risk here is flexibility. If the beneficiary decides to attend an out-of-state school or a private college not covered by the plan, the prepaid plan might not cover the full cost of tuition there, and you might only get your contributions back plus a small amount of interest.
Okay, so prepaid is about locking in tuition rates, less flexible. What about the savings plan type?
In contrast, an educational savings plan, which is the more common type of 529, has no guaranteed benefit tied to tuition inflation. Instead, your contributions are invested in a portfolio of underlying investments, typically mutual funds containing stocks and bonds, similar to a 401k. The value of your account is subject to market conditions and investment performance. This means the funds you accumulate may exceed the actual cost of education if investments perform well, or they could potentially fall short if markets perform poorly, especially close to when the funds are needed. A key feature here is that the account owner, usually the parent or grandparent, maintains control over the assets and investment choices, not the student beneficiary. This provides more flexibility if the student doesn't go to college or if funds are needed for a different beneficiary.
That flexibility sounds good. Now, how does money get into a 529 plan? You mentioned gift tax rules.
Yes, a major tax planning advantage of 529s comes from how they interact with federal gift tax rules. Contributions to a 529 plan are considered gifts to the beneficiary for gift tax purposes. Normally, gifts are limited by the annual gift tax exclusion amount before they start using up your lifetime exemption or potentially trigger gift tax. For 2023, that annual exclusion was $17,000 per donor, per recipient. However, 529 plans have a powerful special rule. An individual can contribute up to 5 years' worth of the annual exclusion amount at once into a 529 plan for a single beneficiary. So in 2023, that meant one person can make a lump sum contribution of up to $17,000 equals $85,000 per beneficiary. For married couples who elect to split gifts, this jumps to an incredible potential upfront contribution of up to $170,000 per child in a single year, all without incurring gift taxes or using up any lifetime gift tax exemption. This allows for significant front-loading of a 529 plan, getting more money working and growing tax-deferred sooner. The catch is, if you use this 5-year acceleration, the IRS treats it as if you made 5 separate annual gifts over 5 years, so you generally cannot make any additional gifts, including more 529 contributions, to that same beneficiary during that 5-year period without potentially triggering gift tax consequences.
Wow, $170,000 upfront from a couple per child is huge. That front loading is powerful. Okay, so the money grows tax deferred. What exactly counts as a qualified expense to make the withdrawal tax-free?
Good question. For qualified higher education expenses from a 529 plan, the definition is fairly broad. It includes tuition and mandatory fees, books, supplies, and equipment required for enrollment or attendance. And crucially, it also includes room and board costs, provided the student is enrolled at least half-time. This is a significant benefit, as room and board can be a huge chunk of total college costs. The amount allowed for room and board is generally limited to the allowance included in the college's official cost of attendance budget. Recently, rules have also expanded to allow limited use for K-12 tuition up to 10 cares, and even some student loan repayment, $10K lifetime, adding more flexibility.
Room and board is key. Now, you mentioned withdrawals might be taxable if they exceed qualified expenses. How does that work, especially if the student gets scholarships?
Right, let's look at the potential taxable portion of distributions. Remember, distributions of your original contributions, the principal, from a 529 plan are always non-taxable. They're just a return of your own after-tax investment. However, distributions of the earnings portion of a withdrawal may be taxable if the total amount distributed from the 529 plan during the year is more than the student's adjusted qualified education expenses for that year. Adjusted qualified education expenses, AQE, are the student's total qualified expenses minus any tax-free educational assistance they received, such as Pell Grants or tax-free scholarships. You can't double-dip tax benefits.
Okay, adjusted expenses. Can we use that Joe example to see the calculation?
Sure, let's walk through Joe's 529 QTP distribution calculation carefully. Recap. Joe's parents contributed $20,000 to his 529, and the account grew to $30,000, meaning $10,000 in earnings. In his first year of college, Joe had $9,000 of total qualified education expenses. He also received a $6,000 tax-exempt scholarship. He then received a $5,000 distribution from his 529 plan. We need to figure out the earnings portion of this distribution first. Since the account is 13 earnings, $10K earnings, $30K total, his $5,000 distribution consists of roughly $3,333 principal and $1,067 earnings. The outline example used $4K principal dollar earnings. Let's adjust that for consistency with the source. Let's say the distribution was $4,000 principal and $1,000 earnings. Now we calculate Joe's adjusted qualified education expenses, AQE. That's his $9,000 in total qualified expenses minus the $6,000 tax-free scholarship, which equals $3,000. This is the amount he can cover tax-free with his 529 earnings. Since the total QTP distribution he received, $5,000, is greater than his AQE $3,000, a portion of the $1,000 earnings in that distribution will be taxable.
To find the tax-exempt portion of the earnings, we take his total earnings distributed, $4,000, and multiply that by the ratio of his AQE to the total QTP distribution. On $1,000 earnings, $3,000 QTE, $5,000 QTP distribution, it's $600. So $600 of his earnings distribution are tax-exempt because they were used for adjusted qualified expenses. The taxable earnings are then the total earnings distributed minus the tax-exempt earnings. $1,000 total earnings, $600 tax-exempt earnings equals $400. So in this case, $400 of Joe's 529 distribution would be considered taxable ordinary income to him. Usually distributions are taxed to the beneficiary. This calculation provides a practical understanding of how partial taxability can occur when distributions exceed the net qualified expenses and why coordinating 529 withdrawals with scholarships is so important.
Okay, $400 taxable. Is there a penalty on that too?
Yes, generally there's an additional 10% penalty tax that applies to the taxable portion of distributions from 529 plans on top of the ordinary income tax. So Joe might owe income tax plus a $40 penalty, 10% of $400 in that example. However, there are some exceptions to this penalty, though not the income tax itself. The penalty is typically waived if the distribution is made to the beneficiary's estate upon their death or if the beneficiary becomes disabled. The penalty is also waived if the distribution was taxable only because the qualified expenses were reduced by tax-free aid, like Joe's scholarship situation, or if the distribution was made because the beneficiary received a scholarship or attended a U.S. military academy.
So Joe likely wouldn't pay the penalty in our example because the taxable portion is due to the scholarship reducing his AQE. Good to know about those penalty exceptions. Okay, moving on from 529s, what about Coverdell Education Savings Accounts, ESAs? How do they compare to 529s? What are their specific tax advantages? They seem like another good option, maybe for smaller amounts, but what are the key differences a listener should know when choosing between these powerful tools?
Coverdell Education Savings Accounts, or ESAs, are another excellent tax-advantaged option for education savings, though they generally operate on a smaller scale than 529 plans. These are separate savings accounts set up specifically for a designated beneficiary's education expenses. Like Roth IRAs, contributions to Coverdell ESAs are non-deductible, meaning you fund them with after-tax money. The maximum annual contribution allowed per beneficiary, the student, is currently $2,000. This limit applies across all Coverdell accounts set up for that particular child, even if multiple people contribute. And contributions can only be made until the beneficiary turns 18 unless they have special needs. There's no limit to the number of beneficiaries you can contribute for, as each child would have their own separate account subject to that $2,000 annual cap per child.
Only $2,000 per year per child. Are there income limits for contributing, like with Roth IRAs?
Yes, similar to Roth IRAs, the ability for someone to contribute to a Coverdell ESA is subject to AGI phase-out ranges based on the contributor's income. For unmarried taxpayers in 2023, the phase-out range was between $95,000 and $110,000 modified AGI. For married individuals filing jointly, it was between $190,000 and $220,000 MAGI. If the contributor's income falls above these ranges, they cannot contribute to a Coverdell ESA for that year.
Right, lower contribution limit, income limits for contributors. What's the tax treatment on the growth and withdrawals?
The primary tax benefits are very similar to a Roth IRA or a 529 plan. Earnings accumulate tax-free within the account. No taxes on the growth year to year. Even better, distributions, both the principal contributions and the accumulated interest earnings, are completely tax-free at the federal level if they are used for qualified education expenses of the designated beneficiary. A key difference here is the definition of qualified expenses. For Coverdell ESAs, it includes qualified elementary and secondary education expenses, as well as qualified higher education expenses. 529s were primarily for higher ed, though recent changes allow some K-12 use. Coverdells have always allowed K-12 expenses like private school tuition or tutoring, offering broader flexibility, especially for younger students. However, just like 529s, if the earnings portion of a Coverdell distribution exceeds the qualified education expenses for the year, That excess earning portion becomes taxable income to the beneficiary and is also generally subject to that additional 10% penalty tax.
K-12 flexibility is interesting. What happens to the money if it's not used by age 30?
That's another key difference. Coverdell ESAs generally have an age limit. The funds must be distributed when the beneficiary turns 30 years of age, unless the beneficiary has special needs. If the funds are simply distributed to the beneficiary at age 30, the earnings portion would be taxable and likely subject to the 10% penalty. However, to avoid this, the balance in the Coverdell ESA can be rolled over tax-free into a Coverdell ESA for another eligible family member, like a sibling or cousin, who is under age 30, allowing the funds to continue growing tax-free for their education. This rollover provides important flexibility. Also, regarding tax credits, you can claim the American Opportunity Tax Credit or Lifetime Learning Credit in the same tax year that you receive a tax-free Coverdell distribution, but you cannot use the exact same educational expenses to qualify for both the tax-free distribution and the tax credit. You need to allocate expenses strategically to maximize both benefits if eligible.
Okay, Coverdells offer K-12 use and rollover options, but have lower contribution limits and income phase-outs. Good to know the trade-offs. Beyond these dedicated savings plans like 529s and Coverdells, you mentioned even something as seemingly simple as U.S. Series EE savings bonds can offer tax-exempt interest for education. How does that work, and is it a strategy many people can actually use?
Yes, it's a less common strategy these days, but U.S. Series EE savings bonds issued after 1989 do offer a unique potential tax benefit related to education. The interest income earned on these specific savings bonds can be entirely tax-exempt at the federal level if the bond proceeds, both principal and interest, are used to pay for qualified higher education expenses during the same year the bonds are redeemed. This applies if the expenses are for the taxpayer redeeming the bonds, their spouse, or their dependents. And similar to the 529 Coverdell rules, the amount of qualified expenses is reduced by any other tax-free educational assistance received, like scholarships or grants. Qualified expenses for this purpose include tuition and mandatory fees. Interestingly, you can also use the proceeds to make contributions to a Section 529 plan or a Coverdell ESA, effectively funneling that tax-free interest into another tax-advantaged education savings vehicle. The bond must also be registered in the name of the taxpayer or spouse, not the child.
Okay, tax-exempt interest if used for education. But is there a catch? An income limit again?
Yes, there's a significant catch. This interest exclusion is not available to everyone. It's subject to a fairly restrictive AGI phase-out. For 2023, this interest exclusion was proportionally phased out for taxpayers with modified AGI between $91,850 and $106,850 for unmarried individuals. And for those married filing jointly, the phase-out range was between $137,800 and $167,800. So it's primarily a potential benefit for lower to middle income taxpayers. If your income is above those thresholds when you redeem the bonds and pay the education expenses, the interest earned on the bonds will be fully taxable at the federal level, just like regular interest income, even if used for qualified education costs. The tax benefit disappears for higher earners.
Got it. So EIA bonds are an option, but income limited.
Okay, let's talk about the reality for many students. Student loans, grants, and scholarships. These are often essential pieces of the funding puzzle. Are there tax benefits or implications to consider there, both for the student and maybe for their parents who might be helping out? It seems like another complex area with a lot of potential pitfalls or planning opportunities.
Absolutely. Even the way education is paid for through financial aid can have significant tax angles that can impact a family's overall financial picture. Let's break down a few key areas. First, student loan interest. For those who've taken out student loans to pay for education, the good news is that you may be able to deduct the interest you pay on those loans each year. This deduction is an adjustment to income, which means it reduces your adjusted gross income directly. You don't need to itemize deductions to claim it. The deduction is limited to a maximum of $2,500 per year per tax return, not per loan or per student. It's an above-the-line deduction, which can be quite valuable in lowering your taxable income.
$2,500 interest deduction sounds good. Any income limits on that one, too?
Yes, unfortunately, this deduction is also subject to an AGI phase-out. For unmarried individuals in 2023, the deduction started to phase out for AGIs between $75,000 and $90,000. For married taxpayers filing jointly, the phase-out range was between $155,000 and $185,000. The deduction is completely eliminated once your AGI reaches or exceeds the upper end of these ranges. There are also other requirements. Married taxpayers generally must file jointly to claim this adjustment. A student who can be claimed as a dependent on someone else's tax return cannot claim the deduction themselves. The taxpayer claiming the deduction must be legally obligated to pay the loan interest, even if someone else, like a parent, actually makes the payment. And the loan must have been taken out solely to pay for qualified education expenses, not for other purposes like consolidating other debts or using a home equity loan.
Okay, student loan interest deduction is helpful, but income limited and has rules. What about grants, like Pell Grants?
Moving to grants, such as the Federal Pell Grant or the Federal Supplemental Educational Opportunity Grant, FSEOG, a major benefit is right in the name. These are grants, not loans. This means they do not have to be paid back, and there's no interest due ever. They represent free money for education. Generally, these types of need-based grants are considered tax-free to the student, which is a significant relief for students and families, directly reducing the net cost of education without adding to future tax burdens.
Free money is always good. What about scholarships and fellowships? Are they always tax-free?
For scholarships and fellowships, the tax treatment can be a bit more nuanced. They are typically tax-exempt, meaning not included in the student's gross income, if two main conditions are met. First, the student must be a candidate for a degree at an eligible educational institution. Second, the scholarship or fellowship funds must not represent payment for services provided by the student, like teaching, research, or other services required as a condition for receiving the grant, unless it's part of certain national service programs. Crucially, for the funds to be tax-free, they must be spent on qualified education expenses. For scholarship purposes, this includes tuition and mandatory fees, as well as required books, supplies, and equipment. Importantly, amounts received under a scholarship that are used for room and board are generally not considered qualified expenses for tax exemption purposes and would typically be taxable income to the student. So a scholarship isn't automatically 100% tax-free. How the money is required to be used or actually used matters.
That room and board distinction for scholarships is key. Good to know. Any other related tax breaks? What about tuition reductions from schools?
Yes, lastly, tuition reductions offered by educational institutions themselves can also have specific tax implications. An undergraduate tuition reduction provided by an eligible educational institution is generally tax-exempt, excluded from income, if the reduction is for the education below the graduate level of the student who is a current or retired employee, or the spouse or dependent child of such an employee at that educational institution. It's a valuable employee benefit. For graduate students, the rules are slightly different. Tuition reductions received by graduate students who are engaged in teaching or research activities for the institution may be taxed if that tuition reduction is their only form of compensation for those services. However, if the tuition reduction is provided in addition to other taxable compensation like a salary or stipend, then the tuition reduction itself may still be tax-exempt under specific rules, Section 1 and 17D. These nuances in how tuition benefits are structured can make a big difference in the net cost of education, especially for employees of educational institutions and graduate students.
Okay, lots of tax angles, even in financial aid. Good to be aware of. All right, let's shift to our final major area, protecting what you've built. Beyond just growing your wealth and saving for big life events like retirement and education, proactively protecting what you have is absolutely crucial. And even here, in the realm of insurance and estate planning, there are smart strategies with significant tax implications that can safeguard your financial future and ensure your legacy is preserved the way you intend.
That's exactly right. Risk mitigation is a fundamental part of any comprehensive financial plan. It's about proactively choosing methods to avoid or lessen the impact of potential catastrophic financial loss. While risk is just pervasive in life, from health risks to investment risks to liability risks, the objective isn't necessarily to eliminate all risk, because that's impossible. It's about managing it effectively. We generally categorize risk control methods into 4 broad areas: risk avoidance, not engaging in the risky activity; risk reduction, taking steps to lower the chance or severity of loss; risk retention, self-insuring or accepting the potential cost; and risk transfer. Insurance is a classic primary example of risk transfer. You essentially pay a relatively small, predictable premium to an insurance company, and in exchange, they agree to bear the financial burden of a potentially devastating but hopefully rare financial blow if a covered event occurs. This strategy is particularly effective and often essential for risks that involve a potentially high loss severity but have a relatively low frequency of occurring things like a major house fire, a serious car accident causing liability, or the premature death of a primary income earner. You transfer that potentially catastrophic financial risk to the insurer.
Makes sense. Insurance as risk transfer. Let's talk about life insurance specifically. How does it fit into this risk mitigation picture, and what are the key tax advantages associated with it, especially for legacy planning?
Life insurance fundamentally protects against the economic loss created by death, often referred to as mortality risk. It serves several crucial financial planning purposes. It can provide vital income replacement for surviving dependents who relied on the deceased's earnings. It can help satisfy outstanding debts, like a mortgage or business loans, preventing assets from needing to be sold. It covers final expenses, like funeral costs and medical bills. And it can even be earmarked to help fund children's or grandchildren's college costs. Of course, your insurability based on health, age, lifestyle is a key factor, as all life insurance contracts typically undergo an underwriting process where the insurance company assesses the risk before issuing a policy and setting the premium.
Okay, so it covers key financial needs after death. Are there different types, and do they have different tax treatments?
Yes, there are two main categories of life insurance, with very different features and tax implications. First is term life insurance. You can think of this as being analogous to renting an apartment. It provides pure death benefit protection for a definite limited period, the term, which might be 10 years, 20 years, or maybe 30 years. If the insured person dies within that specified term, the insurance company pays the death benefit to the named beneficiary. If the insured person lives beyond the term, the coverage simply expires, and they're left without insurance unless they purchase a new policy, likely at significantly higher premiums due to their older age. Term insurance is generally much less expensive initially than permanent insurance and is very appropriate for covering temporary needs, for example, ensuring the mortgage is paid off if you die while it's outstanding, or guaranteeing funds for children's education during their dependent years. Importantly, term life insurance builds no cash value. It's purely protection.
Okay, term is like renting. Temporary, lower cost, no equity. What's the alternative?
The alternative is permanent life insurance. This is more analogous to homeownership. It's designed to provide coverage for your entire life, as long as premiums are paid. And critically, it includes a savings component that accumulates cash value over time. Examples include whole life, universal life, and variable universal life insurance. At some point, often after many years, the accumulated cash value within the policy, or perhaps policy dividends if it's a participating whole life contract, may become sufficient to cover the future premium payments, potentially making the policy self-sustaining.
Permanent has that cash value component. Does that bring tax advantages?
Yes, permanent life insurance offers several crucial tax advantages related to that cash value growth and the death benefit. First, the cash value accumulated within the policy grows on a tax-deferred basis. You don't pay annual income taxes on the internal growth or earnings inside the policy. Second, if the policy pays dividends, common with whole life from mutual insurance companies, those dividends are generally considered a return of premium and are therefore income tax-free up to the total amount of premiums you've paid into the policy, your cost basis. Third, you can typically access the cash value during your lifetime without immediate taxation. You can often withdraw funds up to your basis, premiums paid, tax-free, based on a first-in, first-out FIFO accounting principle. Or, more commonly, you can take policy loans using the cash value as collateral. These loans are generally not considered taxable income, offering a powerful way to access liquidity from the policy tax efficiently while you're alive, though outstanding loans produce the death benefit. Finally, and perhaps most significantly for wealth transfer, the death benefit paying out to beneficiaries upon the insured's death is generally received completely income tax-free.
Income tax-free death benefit. That sounds huge for estate planning.
It is. Permanent life insurance contracts often become a vital piece of the portfolio for high net worth individuals and families who anticipate potentially being subject to federal or state estate taxes. While the death benefit might be included in the deceased's taxable estate, unless owned by an irrevocable trust, for example, the fact that the proceeds are received income tax-free by the beneficiaries means they can provide immediate tax-free liquidity. This liquidity can be used specifically to pay the estate taxes due, allowing the rest of the estate assets like a family business or real estate to pass intact to the heirs without needing to be sold off quickly, potentially at fire sale prices, just to cover the tax liability. This is where the real strategic genius can come in. Permanent life insurance becomes a critical tool for facilitating intergenerational wealth transfer, especially in larger estates, by providing a ready, liquid, and tax-efficient source of funds to cover significant estate settlement costs and taxes, preserving the bulk of the family's legacy.
That makes a lot of sense, using life insurance liquidity to pay estate taxes. Okay, speaking more broadly about wealth transfer and leaving that legacy, how can we ensure assets actually go where we intend them to go as efficiently as possible and without unnecessary costs or delays after we're gone? This seems like where strategic tax and estate planning really comes into play, going beyond just having a basic will. It sounds like proactive choices today can really benefit your loved ones tomorrow.
This is such a critical area, and one that's often overlooked or put off, sometimes leading to significant headaches, unintended consequences, and unnecessary costs for heirs down the road. A primary goal of much estate planning is often probate avoidance. Remember probate. It's that formal, court-supervised legal process we discussed earlier, used to validate a will, pay off debts, and distribute a deceased person's assets. It can easily incur substantial court fees, attorney fees, and accountant costs. Plus, it can be a very lengthy process, sometimes taking months or even years, during which assets might be tied up. All of these costs and delays ultimately reduce the amount that is actually distributed to your intended beneficiaries. So, emphasizing that reducing the amount of assets that have to go through the probate process is a useful and important financial planning strategy is key. And critically, any steps to achieve this must be completed prior to your death. Your will is essential as it provides the overall plan for your probate estate, but many types of assets can, and often should, be structured to bypass probate entirely, making the transfer to your loved ones much faster, cheaper, and more private.
Okay, avoiding probate is the goal for efficiency. What are some of the key strategies people can use to make that happen and ensure a smoother transfer of their assets?
There are several effective strategies to avoid probate and ensure a smoother, more efficient transfer of assets according to your wishes. First, setting up a living trust, often called a revocable living trust. This is a legal document you create during your lifetime that designates a trustee, often yourself initially, then a successor trustee upon your death or incapacity, and provides detailed instructions for how your assets should be managed and distributed after your death. The primary benefit of funding assets into a living trust is that those assets bypass the probate process entirely upon your death. The successor trustee simply steps in and distributes the trust assets according to your instructions in the trust agreement, without needing court approval or oversight. This makes the transfer significantly smoother, faster, and usually less expensive than probate. For living trust to be effective, however, the assets must be formally retitled during your lifetime to indicate ownership by the trust. For example, the John Smith Revocable Trust. Just creating the trust document isn't enough. You have to fund it.
It's crucial to note, though, that retirement accounts, like IRAs and 401ks, generally should not be titled in the name of a living trust due to potential complications with beneficiary designations, required minimum distributions, and possible unintended tax consequences. They usually pass via beneficiary designation instead. But most other assets, real estate, bank accounts, brokerage accounts, personal property, can be held by the trust.
Okay, living trust bypasses probate if funded correctly. What else?
Second, using automatic transfer of assets designations, commonly known as payable on death, POD, and transfer on death, TOD registrations. These designations allow assets to automatically transfer directly to named beneficiaries upon your death, completely bypassing the probate process. Payable on death POD designations are typically used for bank accounts like checking, savings, money markets, and certificates of deposit CDs. Transfer on death TOD designations are typically used for securities like stocks, bonds, and mutual funds held in brokerage accounts, and in some states, even for real estate deeds or vehicle titles. Both POD and TOD automatically transfer ownership to the named beneficiaries upon presentation of a death certificate without needing to go through the will or probate court. You can usually name single or multiple beneficiaries and even specify the percentages each should receive, ensuring your wishes are followed simply and directly for those specific assets. It's a very simple yet powerful probate avoidance tool.
POD/TOD sounds straightforward. What about beneficiary designations generally?
Third, and incredibly important, are beneficiary designations on accounts like life insurance policies, retirement accounts, IRAs, 401ks, 403ds, annuities, and sometimes even brokerage or bank accounts, as an alternative to POD/TOD. These designations are extremely powerful because they typically take precedence over the terms of your will. This is a critical point many people miss. This means that if your will says your IRA should go to person A, but your IRA beneficiary designation form names person B, then person B gets the IRA, regardless of what the will says. The contract controls. Beneficiary designations allow for the direct transfer of those specific assets to the individuals, or trusts or charities you name, bypassing probate entirely. If you name multiple primary beneficiaries, you can usually specify the percentage each is to receive. You should also name contingent beneficiaries in case the primary ones predecease you. Keeping these designations up to date after major life events like marriage, divorce, birth of children, death of beneficiary is absolutely essential estate planning maintenance.
Precedence over the will is huge. Definitely need to keep those updated. Any other common ways to title assets for probate avoidance?
Fourth, titling property using joint tenancy with right of survivorship, JTWRS. When property like a house, a bank account, or a brokerage account is held by 2 or more people as joint tenants with right of survivorship, it has an automatic survivorship feature. Upon the death of one joint owner, their share of the property automatically passes directly to the surviving joint tenant by operation of law. This transfer happens outside the terms of the deceased owner's will or trust agreement and completely bypasses the probate process for that specific asset. It's a common way for married couples to hold title to their home, for example. However, using joint tenancy can sometimes have unintended consequences, especially if used with non-spouses, like adding a child as a joint owner on an account, as it gives the joint owner immediate rights and could expose the asset to their creditors. So while it avoids probate, it needs to be used carefully. All these strategies, living trusts, POD/TOD, beneficiary designations, joint tenancy, raise that really important question for everyone listening. Have you reviewed all your beneficiary designations and how all your significant assets are titled recently?
Do they accurately reflect your current wishes? And do they work together efficiently to minimize costs, delays, and taxes for your heirs? These proactive steps you take today can save your loved ones considerable time, money, and stress during an already difficult time. It's truly about completing your financial plan and ensuring your legacy is handled smoothly.
Fantastic overview of those probate avoidance tools. It really underscores the importance of looking beyond just the will. Well, we've journeyed through a really remarkable landscape of tax saving strategies today, haven't we? From, supercharging your retirement nest egg with 401ks and IRAs to strategically funding education using 529s and coverdels, and finally protecting your legacy with smart insurance choices and careful estate planning. It's become crystal clear, I think, that truly understanding these nuances, the rules, the options, the tax implications can genuinely transform your financial future, moving you from just sort of saving money to actively strategically building lasting wealth.
Absolutely. And if we try to connect all these threads back to the bigger picture, it really is about being proactive. It's about making informed choices consistently, choices that then compound positively over time, ultimately giving you greater control over your wealth and your financial destiny. And from that really strategic choice between traditional and Roth accounts, constantly weighing your current versus expected future tax situation, to the undeniable power of maximizing that employer match, which is just step one, and leveraging the tax-free growth potential of education funds like 529s, or understanding the real after-tax rate of return on your investments, even knowing how to structure assets to bypass probate. Every single one of these decisions, these informed actions, builds towards a more secure, more prosperous financial tomorrow for you and your family. Understanding these mechanisms isn't just academic, it's directly impactful, putting more of your hard-earned money to work for you and ensuring more of it stays with you and your loved ones in the long run.
Perfectly said. It's about proactive, informed choices. And as we wrap up, it's important to remember that as tax laws inevitably evolve, and as your own personal circumstances change throughout your life, maybe your income goes up or down, you get married, have kids, start a business, the financial planning you do today, especially around tax efficiency, isn't really a one-time event, is it? It's more like an ongoing dialogue with your future self, a continuous process of reviewing, adjusting, and optimizing your strategies. So the final thought we want to leave you with today is this. What opportunities might you be missing right now by not diving even deeper into your own personal tax strategy? Are there stones you haven't unturned? And how might overlooking those opportunities today impact the financial security you build for yourself and ultimately the financial legacy you hope to leave behind?